Hello, in this video I am going to cover how a variable rate mortgage, how the interest is actually calculated. So really there's three main different types of variable rate mortgages. There's a SVR, there's a discounted mortgage, and then there is called a tracker mortgage. So the SVR stands for standard variable rate, and the others obviously just discounted and tracker. Okay, so standard variable rate, if let's say you're on a fixed rate mortgage of 5% for, let's say, it's pretty common to get something like 2 years, for example. Afterwards, you will most likely be put onto a SVR. SVR generally has, in the long run, higher interest rates, and if you can, you want to be put onto a discount. So the SVR, they'll put you on there, and the interest rate will vary. So how is this calculated? So there's a bunch of factors that go into calculating this. There's, it's calculated based on how well the economy is doing. It's based on inflation as well. Higher the inflation, higher the interest rates. It's also based on the bank's success. So if, let's say, the bank is struggling a bit, they need a bit more money, they might increase the interest rate if they're doing better and they can afford to take the hit, then they might lower it. Supply and demand obviously as well. That always has a play in everything, supply and demand, other stuff as well, such as credit score as well. Credit score, your mortgage term, which is the length. I've got separate videos covering all this stuff. Mortgage term as well. Your LTV is also used to calculate this as well. So the LTV, the loan to value ratio, essentially this is the reverse of your deposit. So the higher the deposit, the lower the LTV. The lower the LTV, the lower your SVR. So the discounted one is something that you would usually discuss with the bank, and it's usually just a discounted version of their standard variable rate. Again, this will be for us like a fixed period, and usually won't be for the entirety of the loan, the mortgage. Okay, so let's cover this final one, the tracker one. So the tracker one is linked with something in the UK. It's linked with the Bank of England interest rate plus a fee. So whatever the Bank of England interest rate is, it will literally go up and down with that. So if the Bank of England interest rate is pretty, let me draw a graph. If, let's say, we have the Bank of England interest rate, and let's say it's 1, 2, 3, so this is percentage. Let's say if it's sort of like that means roughly, what about 2.5%, 2.6%? It's pretty stable. But imagine, obviously, you would have time along here. The time frame, you can obviously have a look online and figure out yourself what sort of time frame. Not figure out, get historical time frames. But imagine if you were like this instead. Started at 1%, then went to 3, It's all over the place. That doesn't provide much certainty. That's why people like sort of, standard variable rate, or especially love a fixed rate mortgage. So if, let's say, it's at 1% and the SVR at that period is equal to 3%, you're doing well. If, let's say, when the SVR is, let's say, still 3%, is at this point, and let's say that's 4%, then you're not doing so well. So yeah, so that's the tracker interest rate on a variable rate mortgage. So that's how variable rate interest is calculated on a mortgage. Remember, you have three main types. You got the SVR, which is the standard variable rate. You got the discounted, and you've got the tracker, which is linked with the Bank of England interest rate, the Bank of England interest rate, plus a little fee on top of that as well. You obviously just get the one number, which is the Bank of England interest rate plus the fee. So that's it. If you have any questions, feel free to hit us up on the Discord group. There's finance channels there. And as usual, I look forward to seeing you in the next video.